How can you retire with $1 million in the bank? Hey and welcome to today's video. My name is Julian. On my channel, normally we talk about decentralization, about blockchain, cryptocurrencies, decentralized finance, all things around this. But every once in a while we discuss stuff like entrepreneurship and, like today, finances and a lot of mindset. And today I want to teach you something that I was taught by one of my mentors really early on in my life, gladly, because it has helped me massively. And that is, well, how to kind of automate your finances so that in the fastest time possible you can retire with $1 million or more in the bank. And the reason why it's $1 million is because most of the time with $1 million you can actually get quite far when it comes to retirement, and literally almost no one actually retires with $1 million. So $1 million should be quite safe. However, more and more people today kind of suggest you're probably going to need $2 to $3 million. But let's leave this aside for now. Let's focus on some really basic numbers here. And I want to kind of upfront already say, this is going to be a very mathematical video. We're going to walk through a lot of automation and a lot of steps that you can do to really automate that and get this going for yourself. So we're going to have a screen share, I'm going to have a writing pad, and we're going to really work this out. So let's get it work. Let's look at the screen share and let's see what's happening here. I've opened a website here, and it's basically a compound interest calculator. And we can discuss a couple of things here already. What we're basically calculating here is how long is it going to take us to get to $1 million. Now obviously we have a couple of things that we can affect, and we're going to discuss how we get there, but also a couple of things that we cannot affect. For example, one thing is the annual interest rate that we'll be getting. And obviously, yes, we can affect it to a certain degree, but a lot of it has to do with the investments we take and how these investments perform. Now, I have been using 8% because I think it is a very average interest rate that we're going to be discussing, and you will see how this works. You could go a bit higher if you take a bit more risk and a bit more volatility, or you could go a bit lower if you're using a bit less volatility. But let's use 8%, I think that's really fair. And now obviously the big question here is how much time are you saving up to get there, and how much can you put in each month? And we're going to be discussing this in, well, quite some detail here. So for example, let's say, I don't know what age you are, but let's say you have 30 years to kind of until you want to retire. And let's go down and say, okay, you have $750 US that you're putting in, and we have a compound interval, so that's always when we get the interest. So it's a quarterly interest. That's quite realistic. Let's calculate that and see where we end up here. And I think I don't have Wi-Fi. Give me a second. I should have checked that right before. So let's get the Wi-Fi going to make sure that we can get a calculation here. And let's calculate that and see what turns out. So you can see everything gets added up here. So we actually end up a bit over $1 million. So if you have 30 years, you probably can save around $700 a month, and you would be getting close to $1 million. So we would be probably at 650. And 650, and we're gonna look into how you could actually split those and how this actually works. So between 650 and $700 over 30 years. So if you, let's say you're 30 right now, then you would be going in retirement with $1 million. And I can highly recommend that you take these matters in your own hand, simply because, well, who knows what the government does. So yeah, I think it's important to do that. If we kind of take this down and say, okay, I want to retire in 25 years, you probably have to go up here, and you have to go up to $1,000. And I'm going to link this up below so you can play around with this. If you're listening to the podcast also, you can play around with this calculator. So if you're saving $1,000 a month, then you're going to, well, need to have around 25 years. And now obviously you could be very aggressive. Now one thing you will see is over 10 years, you have to put in a lot of money. And the reason is very simple, because interest, compound interest, cannot really work yet, right? So having these really short time frames, like retiring in 10 years, compound interest doesn't really work. So you have to put in a lot of money, because you cannot get this interest going here for yourself. And you can see this here in the total interest category, right? So this really starts working when you give it a bit more time. So many times it makes sense to put in a bit less here, but have maybe a 20-year time frame. And you will see this is actually here. I could almost, I think, go down to probably 1,000, probably 200. Let's try it out and see what's gonna turn out here. We're gonna get way closer already. And obviously it's way easier to save off $1,200 versus $4,000 a month. We're talking monthly here. And now with 1,400, we're getting closer. So let's take 1,600 and see where we are getting here. Great. So now we're getting actually closer. So 20 years, around $1,700. Well, it's aggressive, saving that away. But so 1,700 over 20 years, that would do it. The key is, and that's obviously the very first step, is to kind of calculate for yourself what's the time frame, how much can you actually put away, and we're going to go into detail on this one now. But that's kind of where we get to at the very, very beginning in all this calculation, because that gives us a number at the end. So what we're going to do now is we're going to say, you know what, we're going to try to aim for $1,000. It's probably going to take us 26 years. I think that's what I calculated once. Great. So 26 years, $1,000. And yeah, that's that obviously would work here. Now, one thing you can do is you can adjust it with inflation. I wouldn't do that for now because that's purely for the mathematical model. And generally, these assets kind of move along with it, so I would just leave this aside. Now, what we're going to go into right now is how can you automate that? I mean, that's going to be really, really important. And what we are assuming here is that you have this personal income. And in this case, we're talking about $1,000. And so obviously we're talking about net income here. And this is now really, 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 really important. So you have this pot and you get a salary in there, right? And that's the salary. Now the key thing here is stuff that always goes out are taxes. Another thing that always goes out are insurances or social insurance, whatever, social contributions. But so now there's something left over, right? And this is now the really key thing. The biggest mistake people do whenever they get their salary, they take out everything else. So they take out everything else first. They take out their phone bill first. They take out their car payments. They take everything else out first. And this is the biggest mistake that you can do. What you have to do is you somehow have to squeeze out this part here first. Obviously, taxes, insurances, social, there's some things that you cannot really avoid that are going to just be stuck there, but you have to be adamant in making sure that you take this money out as quick as possible. And I'm going to show you how, in what kind of time frames I did it, but I want to be very clear that I had, well, some luck as well. But at the end, it's very, very predictable what you can do there and how things work. And so now you're basically having these $1,000 and you're kind of splitting this up. And I'm going to give you a couple of categories that I split it up today and what I used to split it up in the past. And so the very first one is, I'm going to give you 10 actually. The very first one is ETFs. And the reason I do ETFs is, in this case, for stocks. And this is not a recommendation that you should be doing. I'm going to give you what I have been doing for quite some time. And I put in 15% of whatever I had coming out of this pot go into ETFs. In the US, you can use services like Wealthfront, Betterment. There's so many companies. Here in Singapore, a lot of people use Stashaway. These are a lot of these robo-advisors where they just put in these saving plans. The second one is bonds. And here you also use ETFs. And you use 15%. What you're doing, that's up to you, but that's basically what I'm doing. Then you have commodities. And commodities, I also use ETFs, and I put in 7.5%. Then I have precious metals. Now, I do it physical, but you can also use ETFs for that. That's up to you. And here, I also do 7.5%. I normally split half-half between silver and gold. Sometimes I do 3/4 gold, 1/4 silver. That's just how I feel in that month and maybe what prices are. Generally speaking, I try to buy full ounces, so maybe it's going to take me a little bit until I get to an ounce. So it might be that I only buy an ounce every year, for example. That's relevant here. Now let's get to number 5. That's real estate. Now, real estate really depends on how much money you can put in and how this actually works. For the $1,000, so in this case, we put in 15%. So $150 a month, it's not going to get you far with some real estate. So this either you save this up in a separate account, or one thing that I would be doing is get a REIT, a real estate investment trust, basically similar to an ETF. It's not the same as an ETF, but let's just say it's similar. and it allows you to save into those, and yeah, that could be very, very interesting. Another one that I would definitely be using is something called peer-to-peer lending. Here I put in 10%, and this works really, really well. There's a lot of platforms, Lending Club and so on, that you can use. And then you have one that I'm obviously a huge fan of, and that's crypto. I put in 10%. I would also save into this. If you're really new to crypto, let me show you something that I'm going to link up below. It's a VIP workshop that for 29 euros. You actually learn everything there is in crypto. I put everything in there. You learn what exchanges to use, what coins to use, how to set this all up, how to kind of work the flow, how to set up your savings plan. It's really all in there. I make a lot of videos, a lot of webinars in there, and I think, well, very, very, very easy to work this out. We've had thousands of people use it, and it definitely works. If you have never met me before internationally, I'm really experienced in blockchain and crypto. I've been in this for 5 years. So yeah, this might be a very nice deal for you. So you can go to products.cryptofit.de/Bitcoin-VIP-EN, and I'm going to link it up below so you can kind of check this out. So crypto. Then number 8 is collectibles. Now collectibles I would only do if you really know your stuff. That's why I write 5% there. Only do it if you really know your stuff. But this could be quite interesting. So if you have some collectibles, could be any kind of cards, any kind of stamps, wine, whatever, 50 bucks a month in this case, you can put in there. You have to know your stuff if you're investing in collectibles. I do it very rarely because I'm not an expert on those collectibles. Another one is gambles. And gambles just doesn't mean that you go gambling. It means that this can be something where like, hey, you know what, this doesn't fall really under anything to invest in. That's 50 bucks, it isn't much. But it might have some really, really insane upside potential, and you can just try this out, or you can play around with it. Most of the time, these gambles actually don't work out, but so you still have this a bit on the side. And the last one, and I think that's really important, is cash. And it is an investment. It's 10% of my regular goes in there, and what I try to have is I try to have 6 months of expenses. So I'll save it up until 6 months of expenses, and then I'll just leave it unless I feel, well, the economy or something is a bit shaky. Then I like to put on those 10% and just distribute it over different currencies. Generally, I use the dollar, I use the euro, I use Sing dollar because I live in Singapore, I use Swiss francs. Yeah, these are the major currencies that I use. Or that I hold and I store my funds in. This has been proven to be quite well so far. One thing, if you have consumer debt, so I'm not talking about investment debt. So for example, if you buy a house or an apartment and you put money in there, that's good debt because normally, hopefully, your loan is being paid off by the returns you're making. But if you have consumer debt, one thing I would be doing is I would put 50% in here and 50% to pay off your debt in case you have debt. I think that's really, really important. Now here's the trick. How much of this should go out here? And whenever it's possible, right? So that's the key. Whenever possible, you put out at least 10 to 20%. Now obviously, if you can, right, with 10 to 20%, you would need to be making 5 to 10,000 US dollars. It's quite a lot of money net. But so maybe you can push this up a bit higher, right? Maybe you can go to 30%, to 40%, but I would really try to do whatever comes in here, 10% goes back out. And I think that is really, 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 really important in this entire case here, whenever possible. But so now there's a couple of other things that I would be taking out, and that is important. There's actually 6 takeouts that I would do, and I mean this. The very first one is personal development. Personal development, and I try to take out 5 to 10% per month out of this, right? This is important. The big mistake that I see a lot of people do is they take out as much as possible and invest it, but then they don't learn how to increase, for example, their income or how to get more money out of there, because that also helps. For example, buying this Bitcoin course, 29 bucks, there shouldn't be any excuses. Hey, if you can really increase your returns here, that could be very, very interesting, right? So don't be cheap here. Go to seminars, do courses, buy books is a must. 5 to 10%. You can obviously, if you say, hey, I'm really squeezed already, go on the low end. But you never want to do zero here. This next one is health. Health is the key. It's without health, you got nothing. So make sure you really invest in your health, 5 to 10%. And this could be checkups, this can be any kind of fitness stuff, this can be a gym, this can be any kind of specific supplements. This is really, really important. Don't cheapen out on this. Another one is experiences, and this can be holidays, trips, and so on. So 5 to 10% goes in there. This is experiences. Experiences are really important. You never know when your life ends. If you have never read this book, then read Time Horizon. Time Horizon Principle. Time Horizon Principle. It's an Amazon. Read this. Really, really powerful on experiences. Very important. The next one is relationships, and that's key. Relationships or networking. This is a bucket. You need to have 5 to 10%. That's important. That can be going to an event, going to a seminar. This can be for your relationship, for your love, for whatever it is. This is important. Put 5 to 10% in there. Then you have crazy fun stuff. So that could be dreams. That can be just, I don't know, blowing it. It doesn't matter. 5 to 10%. And then the last one is donations. You need to give 5 to 10%. So you can be completely flexible and you say, hey, you know what, Julian? I'm really squeezed right now. I mean, my salary and blah, 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 blah. I totally get it. I understand it. I'm going to give you my personal example afterwards. But so you can go and say, you know what? 5%, 5%, 5%, 5%, 5%, 5%. So that's in total 30%. And obviously a lot of the living stuff is in there as well. And then you have around 10%, maybe, yeah, let's go to minimum 10% coming out here. Now, I would not put in too much here and really be cheap on this. Trust me, these things you have to be willing to invest here. It's important. And so at the end, you would have, in this case, 60% for house, car, and so on. Now, I understand a lot of this is optimized, but if you really want to max this, you are going to be way more aggressive here, right? You can switch around with these numbers here a bit. You can go lower or higher on one of those, but that would be something where you're going to be really, really, really aggressive. Now, I'm going to give you a bit of my personal story here, and this is a story that I got asked a lot, so that's personal. So when I was 22, I lost all my money, stupid investments. I was a total idiot. So I was broke. I started at zero. And my goal had always been that at 30, I want to be at $1 million US. Now, the key in this entire thing is, and obviously there's a couple of things that you can affect. So at 8 years, which is nothing, right? So I would not try to become a millionaire in 8 years unless you are willing to do a lot of different things. And so there's a couple of things that I had going for me and that I could influence, and then I had a lot of things that I couldn't influence. Two things that I could influence, or one thing that I could influence was my income. And so my income, I was able to generate quite good income because I was a pro kite surfer and I made quite good money there. And afterwards, I became a doctor, and so I made some good money there. Now, the other thing that I really had going for me was this was during a time, and you can look this up, this was all after 2008, 2019, when real estate, and these were my main vehicles there, real estate and stocks, in this case ETFs, really, really, really skyrocketed. And with really, I'm talking about 30% on average per year compounded. Like it is insane, right? So that was insane. So I made good money. Here. And I was really fortunate on a couple of other things. So if we look here, so ETFs here, stocks skyrocketing. Bonds did fine. Commodities did fine. Precious metal, that was a bit stagnant. Real estate completely went up. Peer-to-peer did fine. Crypto I didn't know about. Collectibles here I did a lot of kite sales, for example. Gambles I did very little, and the cash was there. But so the rest really, really skyrocketed. And so at the end, just with all these calculations here, and I invested a lot in myself. I invested a lot in my health. Experiences I had all the time. I built a really world-class network. I had some crazy fun times, and I donated. And so at the end, it took me 8 years to go from being broke to $1 million. And obviously, this was, again, There's one thing you can influence, it's your income, and the other one is the return. And the return is not something you can influence. That's why I wouldn't set 8 years. Try to set a goal maybe for 15 years or something, 15 to 20 years, and you really have to hustle and get your income up. I mean, stuff here gets very, very easy, and I made a separate video, let me link this up below as well, when your income goes over 10K a month, right, net. So obviously stuff gets easier, especially if you don't have to pay for a family, if you just have to kind of take care of yourself. Now the only way you can get there is if you invest in yourself. That's why this is so important, right? It doesn't help if you're investing $1,000 into all kinds of investments and you don't invest in yourself, because maybe it's possible to put in $4,000 or $5,000 a month because you are at $10,000 a month. This only works if you're working on your income. At the end, there's a lot of math behind it. You need to work with some averages, right? So here we're using 8. Now I had probably 25 to 30%, but just because I was lucky and fortunate with time, and I want to be clear. And obviously, I was not fortunate here because the exact same thing, why the markets went up so crazy, here everything crashed because of that, and me idiot, I lost a lot. So I guess this always kind of works for you and against you. So that's always something really, really important to consider. With this, let me know what you think about this. I hope you get some value out of this. I hope it helps you to retire with $1 million as fast as possible, but almost more important is as strategic as possible. Check out the link, get my crypto course if you want to be informed about this. Subscribe to the channel if you want to hear more about all that. And aside of this, I hope I'll see you at the next video. Yours truly, Julian.